What if the most powerful currency on the planet has been quietly losing its power and almost nobody told you? Somewhere in the last year and a half, the US dollar went through one of its worst stretches in over 10 years, and most people never even noticed it happening. Before we go further, if you want to actually understand what's happening to your money instead of just feeling confused by headlines, hit subscribe right now. This channel breaks down big money stories in plain English, and you don't want to miss what comes next. For 80 years, the dollar has sat at the center of the entire global economy. It is the money that oil gets priced in. It is the money that countries around the world keep locked away in their central banks as their emergency backup. It is the money that international debt gets written in, no matter which two countries are actually making the deal. When a country in Asia trades with a country in Africa, there's a very good chance the deal still gets settled in dollars, even though neither country is American. This gave the United States something economists call an exorbitant privilege. It sounds like a strange phrase, but the meaning is simple. Because the whole world wants dollars and needs dollars, the American government can borrow huge amounts of money more cheaply and for longer periods than any other country on earth. Other nations have to convince investors to trust them. America barely has to try. The world lines up to hold its debt because dollars are seen as the safest asset. That exists. But privilege like that is not free. It rests on one single condition, and that condition is trust. The rest of the world has to believe that America will act like a responsible caretaker of the global financial system. The moment that belief starts to crack, even a little, the whole arrangement starts to wobble. And over the past 18 months, it has been wobbling. The dollar has fallen close to 10% against a group of major currencies in a single year. Against some currencies, like the euro and the Swiss franc, the drop has gone past 13%. That is not a small shift. That is the kind of move that makes central banks around the world sit up and rethink decisions they had assumed were settled for good. Here's the part that should really catch your attention. Nobody can fully agree on why this is happening. Some experts think this is just an ordinary market cycle, the kind of thing currencies naturally go through. Others believe something far more deliberate is going on, that people in power actually want a weaker dollar because it benefits certain parts of the economy, even if nobody wants to say that plainly on camera. Two very different explanations, two very different futures, and right now we genuinely do not know which one is true. So let's slow down and actually understand how we got here, because you cannot judge how serious this is without seeing the full picture first. A mix of forces collided over the past year and a half. New tariffs disrupted trade relationships that had been stable for years, and they made global partners nervous about what American trade policy might look like next month, let alone next year. The government pulled back from several international commitments, stepping away from global organizations and reducing certain kinds of foreign support, which sent a message that America was turning its attention inward. At the same time, something unusual started happening to one of the most trusted institutions in the world, the Federal Reserve. Serious questions began circulating about whether its independence, its ability to set policy based on economic data rather than political pressure, was starting to erode. New leadership with a very different approach sparked concern among investors who have spent decades relying on the Fed, acting like a neutral referee, not a political player. And underneath everything, there's the debt, the kind of debt that keeps piling up no matter which party is in charge, deficits that keep growing year after year with no serious plan to shrink them, a bond market that has started demanding higher returns just to keep lending the government money, because lenders are starting to price in more risk than before. Put those pieces together, and you get exactly what has played out. Investors around the world, from giant central banks to everyday savers overseas, have started rethinking how much of their wealth they want sitting in dollars. And when that kind of thinking shifts even slightly across a financial system, this massive, the ripple effect is enormous because we are talking about trillions of dollars potentially being moved or repositioned. Now here's where the real debate begins and where smart, serious people land on completely different sides. One group argues this is not an accident at all. In their view, a weaker dollar has quietly become something close to a strategy. A cheaper dollar makes American exports more competitive overseas. It makes American manufacturing look more attractive next to foreign competition. It helps chip away at trade imbalances that have been political flashpoints for years. Under this theory, the dollar's decline is not something happening to America. It is something being allowed to happen on purpose, even if no official will ever say those exact words in public. The other group sees it differently. They argue this is not a deliberate plan at all, but the natural result of unpredictable governing. Tariff shocks, questions about institutional independence, deficits spinning without a clear fix. According to this view, nobody sat in a room and decided to weaken the dollar. Instead, A series of disruptive decisions simply chipped away at global confidence, and the currency responded the way currencies always respond when trust starts to slip. Why does this distinction actually matter? Because it changes what might happen next. If this is a deliberate policy, then it can, in theory, be reversed just as deliberately whenever the costs start outweighing the benefits. But if this is really about eroded trust built up slowly across many separate decisions, that kind of damage does not switch back on demand. Trust that took decades to build does not come rushing back the moment one policy changes. It tends to return slowly, carefully, and only after a long track record proves itself again. The same way it takes far longer to rebuild trust with someone who has let you down before than it does to lose it in the first place. If you're finding this useful, do me a quick favor and tap that like button. It genuinely helps this video reach more people who need to understand exactly what you're learning right now. To really understand whether this moment is dangerous or ordinary, it helps to look back at history, because the dollar has weakened before, and those earlier episodes tell us a lot. Go back to 1985. The dollar had grown so strong that it was crushing American exporters and fueling a massive trade gap with countries like Japan and West Germany. The response was a coordinated agreement among major world powers, deliberately engineered to weaken the dollar together. It worked. The dollar fell by roughly half against the yen over the following years. That moment proved something important. A weaker dollar can absolutely be created on purpose through careful, open coordination between major economies who agree it serves everyone's interest. But notice the key difference. That earlier move happened through multilateral cooperation, not through a single country acting alone and catching its trading partners off guard. A currency shift engineered through careful teamwork tends to be stable and reversible. A currency shift that happens as a side effect of unpredictable, go-it-alone decisions leaves everyone guessing about what happens next, and that uncertainty itself becomes part of the problem. Now, look at a more recent and more directly comparable moment, the earlier years of a similar political environment, when tariff battles with China rattled markets and the dollar weakened meaningfully. Back then, it eventually stabilized and even recovered once policy became more predictable and growth-friendly measures kicked in. Some strategists point to that earlier period as a roadmap for what might happen this time too. A sharp, early shock, followed by a gradual recovery once the dust settles and markets adjust to the new normal. If that pattern repeats, this current stretch of weakness might end up being remembered as a temporary correction rather than a turning point. But there is one major difference between then and now, and it deserves serious attention. The scale of the national debt today is nowhere close to where it stood during that earlier comparable period. Interest payments on the national debt are now projected to cross $1 trillion this year alone, and that number keeps climbing. A weakening dollar sitting on top of a bond market already under real stress, with yields reaching levels not seen in almost 2 decades, is a very different and arguably more fragile combination than a weakening dollar occurring against a calmer fiscal backdrop. History can rhyme, but the specific details of this verse are genuinely different from anything the country faced before. Think about it from the perspective of a finance minister sitting in a country that is not the United States. For decades, holding dollars felt like the obvious, almost automatic choice. Dollars meant safety. Dollars meant liquidity. Dollars meant you could always find a buyer, always find a use, always trust that the value would hold steady enough to plan around. That assumption shaped how entire nations built their financial systems, how they priced their exports, how they structured decades of trade agreements. It wasn't just a preference. It was the foundation everything else was built on top of. Now imagine watching that foundation shift, even slightly, year after year. You don't panic, you don't dump your dollar holdings overnight, but you start asking quiet questions you never used to ask. You start wondering whether it makes sense to hold a little more gold than before. You start exploring whether a regional trade deal could be settled in a currency other than the dollar, just this once, just to test the waters. None of these moves feel dramatic in isolation, but multiply that quiet questioning across dozens of countries, across years, and you get a genuine structural shift, even without a single headline event to point to. There's another piece of this story that deserves real attention, because it shapes the long-term stakes far more than any single year's currency swing. It's called de-dollarization, and it has been building quietly for years. Central banks in countries like China, India, and Russia have been steadily increasing their gold reserves, a trend that picked up serious speed after Russian central bank assets were frozen following the invasion of Ukraine. That single event sent an unmistakable message to governments everywhere. Dollar reserves held in Western financial institutions are not automatically safe under every political circumstance. They can, under the right conditions, be frozen or restricted entirely. That moment did more to accelerate central bank gold buying and reserve diversification than almost anything else in the past 20 years. because it proved in the clearest way possible that holding dollars is not the unconditional safe haven it was once assumed to be. Layer that shift on top of ongoing fiscal deficits, growing doubts about central bank independence, and an unpredictable trade environment, and you get a genuine structural trend, one that has been quietly accelerating regardless of which direction the dollar happens to move in any given month. None of this means the dollar is about to lose its position as the world's reserve currency anytime soon. The infrastructure behind dollar dominance runs incredibly deep. The size and liquidity of the U.S. Treasury market, the sheer scale of global trade priced in dollars, and the total absence of any real alternative currency with the same level of trust and stability make replacing the dollar extremely difficult. The euro carries its own baggage from being shared across many independent nations. The Chinese yuan remains tightly controlled, which makes it unsuited to play the same open, freely traded role the dollar has held for 8 decades. Gold doesn't generate yield and cannot function as the foundation of a global payments system the way an actual currency can. So the realistic outcome is not a dramatic collapse. It is something slower and quieter, a world that leans on the dollar, a little less than before, a world that spreads its reserves a little more broadly than before, a world that extends a little less automatic trust toward American financial management than it used to, even while the dollar remains, by a wide margin, the most important currency on Earth for the foreseeable future. Gradual erosion is still erosion, and it still carries real consequences, even without one dramatic breaking point to mark the moment everything changed. Before we go further, if this video is actually helping you connect the dots, share it with one person who still thinks the dollar is untouchable. They need to see this too. Now let's bring this back down to your actual life, because it's easy for a story this big to feel far away from anything that touches you personally. If your grocery bill has crept up on anything with imported ingredients, coffee, certain produce, electronics built overseas, a weaker dollar is quietly part of that story. Every dollar you spend on imported goods stretches a little less far than it did 18 months. There you go. If you've looked into a trip abroad recently and found it more expensive than you remembered, that's not only general inflation. That is specifically your dollars buying less once they get converted into euros, yen, or francs. If your retirement savings sit entirely in American stocks and American bonds with zero exposure to anything international, you are, whether you've thought about it this way or not, placing a very concentrated bet on continued American strength with nothing in your financial life set up to benefit if that strength keeps softening. This isn't a call to panic or to rearrange your entire financial life overnight because of one video. It's a call to actually understand where your money sits inside a genuinely significant global trend, rather than discovering that exposure only after it has already cost you something. Think of it like weather. You don't need to become a meteorologist to know that carrying an umbrella makes sense when the sky looks a certain way. You just need to notice the pattern and adjust accordingly. The same logic applies here. You don't need to become a currency trader overnight. You just need to notice that the pattern has shifted, and that noticing alone puts you ahead of most people who will keep spending, saving, and investing exactly the same way they always have, without ever asking why their money seems to buy a little less than it used to. To be fair, a weaker dollar is not bad news for everyone. If you work for a company that sells products overseas, a cheaper dollar makes those products more attractively priced for foreign buyers, which can support manufacturing jobs and boost company earnings. If you hold international investments, a weaker dollar can actually increase your returns once converted back home. Tourism into the United States also gets a boost because visiting America becomes cheaper for people traveling from abroad. So this isn't a simple story where everyone loses. It's a redistribution story where some parts of the economy benefit while others get squeezed. And the people who tend to get squeezed hardest are everyday consumers buying imported goods, along with anyone whose entire savings sit in dollars with no diversification at all. But there's a deeper concern sitting underneath all of this, the kind that keeps currency strategists up at night. It's the slow erosion of the dollar's reserve currency status itself. For years now, central banks have been quietly shifting a portion of their reserves away from total reliance on the dollar and toward alternatives like gold. This is not countries abandoning the dollar overnight. That scenario remains extremely unlikely, given how deeply the dollar is woven into global trade and debt markets. But it is a real, measurable shift, a gradual rebalancing that chips away, slowly, at the privilege the United States has enjoyed since the end of the Second World War. Think about what that privilege actually means in real terms. It has allowed America to borrow enormous sums at interest rates far lower than almost any other country would ever be offered, because global demand for dollar-based debt has been so deep and so consistent for so long. If that demand weakens over time, even gradually, even without one dramatic event marking the shift, the government has to offer higher returns to keep attracting the same pool of lenders. That means Higher borrowing costs spreading across the entire economy. The same dynamic already showing up in a bond market where yields have climbed to levels not seen in nearly 20 years. The weakening dollar and the stressed bond market are not two separate headlines happening to occur at the same time. They are two symptoms of the exact same underlying issue, a gradual erosion of the rock-solid global confidence that allowed America to borrow cheaply and issue the world's most trusted currency for the better part of a century. The Federal Reserve's role in all of this cannot be overstated. Its independence, its ability to set policy based on economic data rather than political convenience, has long been one of the core reasons global investors trust the dollar as much as they do. A central bank seen as politically influenced, one that might cut rates to please whoever is in office rather than to manage inflation properly, is a central bank whose currency the world trusts noticeably less. That's exactly why recent questions about Fed independence carry so much weight for the dollar's future. If markets start believing the Fed behaves more like a political tool than an independent watchdog, that alone can accelerate a currency's decline, because the basic promise underneath the dollar, that it will be managed carefully no matter who occupies the White House, starts to look far less certain than it has in generations. So where does this actually go from here? Honestly, currency forecasting is one of the hardest exercises in all of finance, and even the professionals are split. Some expect continued softness before a rebound later as interest rate gaps between America and other major economies start working back in the dollar's favor. Others believe the weakness could stretch on longer, especially if rate cuts continue while the underlying fiscal problems stay unresolved. And some point to a real chance that new leadership at the Fed turns out more cautious than markets currently expect, which alone could spark a meaningful rebound, even without any change to the deeper fiscal picture. In plain terms, nobody serious is confidently predicting a collapse, and nobody serious is confidently predicting a clean return to total dollar dominance either. The honest answer is real uncertainty shaped by competing forces pulling in opposite directions at the same time, which tends to produce ongoing volatility rather than one clear, predictable path. Here's what deserves to be said plainly, cutting through both the panic and the dismissiveness floating around this topic. This is not the dollar collapsing. This is not hyperinflation. This is not the end of American economic dominance overnight. The evidence simply does not support that level of alarm. And anyone selling you that story is selling you fear, not facts. What the evidence does support is something more measured, but still genuinely important. The dollar just went through its roughest year in over a decade, driven by a mix of decisions, some possibly deliberate, some almost certainly the unintended consequence of unpredictable governing, layered on top of structural fiscal pressure that shows no sign of resolving on its own. That combination has visibly dented global confidence in American financial leadership, even if it hasn't broken it. And dented confidence, given enough time, has a way of compounding into exactly the kind of structural shift in reserve currency status, borrowing costs, and global financial architecture that took decades to build and could plausibly take decades to fully unwind, even without a single dramatic moment marking the turning point. So what should you actually do with all of this? There's no single dramatic move that eliminates currency. Risk overnight, and anyone promising you one is oversimplifying a genuinely complicated situation. But there are sensible steps worth taking. Start by understanding your own exposure in plain terms. If your entire financial life sits purely in dollars with zero international diversification, understand that you are fully exposed to whichever direction this currency moves, with nothing offsetting that risk either way. That doesn't mean panic selling or jumping into unfamiliar foreign assets. It means recognizing that many credentialed investment strategists are now recommending at least some international exposure as a genuine hedge, not as some fringe idea, but as increasingly mainstream advice. If you travel internationally, budget with the understanding that your dollars simply don't stretch as far as they used to in many major destinations. If you're a cautious saver, understand that safe doesn't automatically mean immune to currency effects, because a dollar sitting untouched in a savings account can still lose purchasing power against foreign goods and services, even while the number in your account stays exactly the same. And more than anything, treat this as an ongoing story rather than a single headline that resolves itself and disappears. The dollar's path over the coming year will be shaped by an unusual number of moving parts happening all at once. What the Federal Reserve's new leadership actually does once decisions are in their hands, whether trade policy stabilizes or keeps delivering fresh shocks, whether the structural fiscal problems underneath the bond market get any real long-term solution or simply keep piling up, and whether the slow, quiet diversification happening inside foreign central banks continues at its current pace or picks up speed. None of these questions have a clean, confident answer right now, and that uncertainty itself is the real story, far more than any single percentage the dollar moved against the euro this quarter. Here's the honest truth before we close this out. There's a version of this story where, a year or two from now, we look back and see this entire stretch as a temporary wobble, a currency correcting itself the way currencies periodically do. It's exactly the kind of pattern that has played out before in American history. And there's another version of this story where we look back and recognize this as an early, underappreciated chapter in something much bigger, the first visible cracks in a system of global financial trust that had gone largely unquestioned for the better part of a century. The moment the rest of the world quietly began hedging its bets on American strength instead of simply assuming it would last forever. Reasonable, experienced people looking at the exact same numbers land in different places on this question. And that disagreement isn't a sign of dishonesty or confusion. It's a sign that we are genuinely standing on uncertain ground, the kind of ground where even lifelong currency experts hold meaningfully different views. That uncertainty deserves to be sat with honestly, instead of being resolved artificially in either direction just because ambiguity feels uncomfortable. Nobody, no matter how confident they sound on camera, actually knows for certain which version of this story we're living inside right now. But one thing is completely certain. Something real has shifted in how the world sees the American dollar over the past 18 months. The numbers behind that shift are large enough to matter to your own financial life, whether you've noticed them yet or not. And history has shown, again and again, that the people who come out ahead during moments like this are rarely the ones with the loudest predictions. They are the quiet ones who paid attention early, who understood the slow signals long before a dramatic headline forced everyone else to finally look up. If this video helped you see the bigger picture behind the dollar, don't scroll away just yet. Subscribe, ring the notification bell, and stay ready, because stories like this rarely stay quiet for long. And when the next shift comes, you'll want to be one of the people who saw it coming, not one of the people caught off guard by it.